Okay, today we're going to do problem 5-4B on page 251. And to set this up, this is going to be a buyer and seller problem. If you look at it here, it says this guy Ben Bork operates Ben's Discorama, and what we're going to do is part A only. We're going to journalize these transactions for April. And so to begin, it says that on April 5th, it says that they purchased, or Ben's Discorama purchased golf discs, bags, and other inventory on account from Innova for $1,200. The shipping terms are $210 net $60, meaning that Ben gets a 2% discount if the balance is paid within 10 days, or the entire balance is due in 60 days and there is no discount. Also, the shipping terms are FOB shipping point, meaning that the buyer owns the goods at the shipping point and the buyer pays for shipping. So to do this, we're going to debit inventory for $1,200, and we're going to credit accounts payable. Okay. Then on the 7th, it says to pay freight on the Innova purchase for $50. So what this means is that the inventory balance gets increased by the $50. And since it did not mention a payment method specifically, we will assume that it's cash for April 7th. Then on April 9th, it says they received credit from Innova for merchandise returned for $100. So Ben is going to get a credit for the inventory return. So we reverse a portion of the initial transaction for the amount that was returned. So we debit accounts payable and we credit inventory for $100. Then on the 10th, Ben is now a seller of merchandise. So they sold merchandise on account for $900. The terms are net $30. There is no discount, and the merchandise sold has a cost of $540. So we have two transactions. The first is we have a sale, and that sale was for $900. So we debit accounts receivable, credit revenue for $900. And then the second transaction, we have to recognize the cost of goods that have been sold. So we have this account, cost of goods sold, that we debit $540, and we credit inventory to show that we've moved inventory out of storage and given to or sold to the customer. Okay, so we have two transactions. Then on the 12th, they made another purchase. It said golf shirts and other accessories on account for $670. So we have our same transaction that we have on the 5th, except for the difference, which was $670. Okay. Then on the next date, on the 14th, it says paid Innova in full less the discount. Okay, so in this case, Ben owes Innova $1,100, the original $1,200 minus the $100 of inventory that was credited or returned. Okay, so our accounts payable balance is $1,100 that we need to debit, and then the discount is credited for, we'll put $1,100 times the discount, and they pay within the discount period, so it's 2%, so it's $22. And we credit cash for the difference, Okay. Then on April 17th, it says they received a credit from Lightning Sportswear for merchandise returned for $70. Okay. So again, we have the same transaction that we do on April 9th, except in this case, it is $70 of merchandise that they returned. Then on April 20th, it says they made sales on account for $610 and the cost of merchandise sold was $370. So we have the same transaction we have on April 10th. So I'll just copy that down. And the difference here is the amounts. Again, so $610 is the sales price. And the cost of goods is $370. Then on April 21st, it says they paid Lightning Sportswear in full less the discount. And remember, there's also a return of merchandise. Okay, so the original accounts payable was for $670. They returned $70 worth of merchandise, so they owe $600. Then we have a purchase discount and cash again. So the terms of the agreement was a 1% discount. So we have a $6 discount. And then we want to credit cash for $594. $594, excuse me, is the credit to cash. Okay. Then on the 27th, it says it granted an allowance to members for clothing that was flawed for $20. Okay. So here we have an account called sales, returns, and allowances. So we debit that for $20 and we credit accounts receivable. And that's for the 27th. And the last transaction on the 30th says they received payments on account from customers for $900. Now if we look at these sales, both on April 10th and excuse me, April 20th, the terms are net 30, so there is no discount. So in this particular case, we want to debit cash and credit accounts receivable for $900. And that completes part A of problem 5-4B.